Hey folks, we're glad you could join us on another episode of Business Redefined, your weekly most comprehensive look at the world of business, finance, and economics. We've been heavy on public finance, want to switch gears and talk about the real estate space in the country, in the region, and especially with a focus on planned multi-purpose developments coming up across the country. And who better place to comment on this than the man in charge of Mivida? Not really a stranger here. Sam Kariki has been here twice now. Sam, karibu sana.
Asante.
Long time no see, Sam.
It's been a long time.
How are things?
Things are great if I look at the business. Depending on one's perspective on what is happening at the macro level globally and the impact locally, maybe some concerns there. But you have to be resilient. You have to keep on doing business on a day-to-day basis.
Sam, the macros, let's start from that point.
Yes.
We have seen a deal being signed around the Middle East, we thank God. But before that, any impact you have seen with spillovers into the real estate space?
Yes, it's been concerning. And a number of developers have then had to sit with contractors and relook at contracts. I'm aware some contractors have had to send notices around fluctuations because whereas this might look like a specific crude oil issue, the disruption of supply chains impact economies, at a macro level. So those disruptions then obviously, because most of our construction materials are imported, has had some effect. Freight costs are higher. I guess contractors or vendors are concerned about delays in shipping and things like those. So yes, there has been a cost implication. And developers have had then to have conversations with contractors and see what hedging mechanisms can be put in place.
Okay.
Yeah.
And therefore now, you have spoken more from the contractor developer side. From the consumer buyer side, are you seeing a bit of lethargy in terms of uptake, or how is it panning out?
And I suppose in the in the short to medium term, maybe yes, because whenever you have this kind of very disruptive events, investors then tend to wait and see. Simply because the investor at their micro level do not know what will happen in the next 6 or 12 months.
Yeah.
When this war started, there were concerns that now in the next 12 months, you'll see a lot of disruption in global energy supplies and the effect on the economy. In Kenya specifically, because of imported inflation, there were then concerns around what would that mean at the macro level of the economy. Investors then tend to have a wait and see. Let's see what will happen, and probably park money in safer money market funds. I guess that would be the almost immediate sort of impact. If I look across the year since Feb, I suppose we've seen some softening of demand.
Yeah.
Is it directly attributable to the global events? Maybe, maybe not. Because I also, I appreciate there's been a lot of localized supply of our kind of product.
Yes.
But yes, there has been some concern.
On a pipeline standpoint, you've been quite active. Elara, we've seen Keza. How are things going?
So far, so good. So far, so good. And I suppose when you run a platform, the benchmark rule is that you need an 8-year pipeline, simply because if you want to operate like an FMCG who has a certain inventory turnover on an annual basis, our inventory from site acquisition to when it hits an income statement takes about 4 years.
That's a long runway.
So my income statement this year will be a reflection of my activities in 2022, 2023.
Oh my God.
Had I not done what I did then, I would have no income statement this year. From land acquisition to the time it takes to plan for projects, conceptualize, originate schemes and iterate to something that you can build, then roughly 2 years to build. And also the observation is even after you complete building, customers take anywhere from 12 to 18 months before they can fully pay. Our revenue recognition is when a unit is fully paid and handed over. So between the site acquisition and hitting your income statement can be anything up to 4 years.
Wow.
So then you have to plan. You have to plan 8 years ahead in terms of pipeline acquisitions, and therefore you must be actively acquiring, even if it's not something you're going to develop this year. It has to be, because you appreciate anyway, what I'm doing now is about my income statement 4 years from now.
Oh my God. But you must have a mechanism of bridge financing where, as you said, the horizon between commencement and hitting your income statement is quite long.
It's quite clear.
In between, how do you smoothen your cash flows there?
So the beauty is that the models of pre-selling and collecting deposit throughout constructions solves for the cash flow side of it.
Okay.
What you might find, especially if you don't run platforms, you just run single projects, is it might be a period of 3 to 4 years before any income can be seen on your income statement, even though the business is generating a lot of cash flow. Now that cash flow sits on the balance sheet as deferred revenue. It might look like a huge liability that a business like ours is holding, but it's really cash I've received as pre-sales to convert to revenue once all these conditions have been met. So I wouldn't say the challenge is necessarily cash flow, because you've pre-sold, but you can't recognize the revenue.
Yeah.
So all this cash is coming in as deferred revenue. Customers are paying through construction milestones. Largely they do. But that said, having said that, I think there is an opportunity in this market to develop financing products that are very tailored to that kind of business operating model.
Yes.
And I've seen, I suppose our markets haven't necessarily matured to that level. What we see in real estate is more project finance type discussions. But when you're looking at platforms, remember this: if say we enter into a contract for a unit for say $1,000 or 1,000 shillings, what effectively you and I have entered into is a forward contract.
Mm-hmm.
And it's a stamped contract. It's a real contract. There's value in the contract. If you pay me 10% of that, say 100 shillings, I have 100 shillings in my bank account, but I have another more important asset. I have a 900 shillings receivable off balance sheet.
Yes.
That is supported by a forward contract. I don't think we've unlocked probably more optimal financing solutions that speak to that kind of operating model. That I'm now financing these receivables because I know they are contracted. I can reconcile them to contract. I know they will sort of convert over the next 2 years or so. Here is a product that at a corporate finance level then speaks to that financing model. I don't think we have. So it's some form of, if you ask me, some kind of leaning towards corporate finance, trade finance than just specific project finance, which I find to be very restrictive.
Okay.
Yes.
There are a number of players in the real estate sector who have told me that in line with what you're saying, the market hasn't matured in terms of development of products. We need to get to a point where asset-backed securities become a thing in this market.
Absolutely.
Are we headed there, Sam? And which shape and form do you see this taking?
To some extent, I think what we've seen are, sprouts, budding sort of examples of that. I would say we've taken baby step towards. Do we have them at scale? Certainly not. I think the easiest form of seeing them take, or shape of seeing them take, is maybe TPS, or what I think could be. So the quasi-public and public institutions in this market have been successful in selling tenant units through tenant purchase schemes.
Yeah.
And in some form, you could argue they could have securitized that receivable, just that they happen to be the largest funds anyway. So they'll be the same people buying.
Buying either way.
But on that one, to the extent that there's demand for tenant purchase scheme, we have seen and we've toyed with a product that says the developer originates the tenant purchase scheme, but because they cannot hold that receivable on their balance sheet for long, none of the developers have that sort of capacity to hold 15-year, 20-year receivables.
Yeah.
You can then securitize that. Now you realize by the time it's a tenant purchase scheme, the housing unit is ready. And then you can securitize a receivable that's then backed by that housing unit. That will be a very straightforward, if you ask me, asset-backed security.
I see.
Yeah.
Interesting. The last conversation we had, Sam, you had intimated that Mivida was structuring a housing fund to go to market.
Yes.
Many Kenyans have reached out. That you guys sat down, this guy gave us a teaser into this, and then has gone quiet.
Yes.
Sam, is this plan still on?
I knew that was coming. We haven't gone quiet. We've been very busy this year with that. If you recall in our last conversation, I said from Q1 of this year, we'll be actively in the market. So the answer is yes, the plan is on and very advanced. At the end of last year, we appointed the transaction advisors who've been working with us. We've appointed the legal and tax advisors, and all the collateral, all the material needed to progress this is now in place. And in fact, we've gone a step ahead. We've been talking to both local and offshore target investors on a non-deal roadshows. to sort of incorporate, sell to them the product, but incorporate a lot of their feedback in how we design that product. It's been very positive feedback. So it's progressing. We are now at the stage of non-deal roadshows to just talk to potential investors, secure an anchor investor in time for us to now move fully into the fundraise from the beginning of Q4, which is only 2 or 3 months away. But yes, we've been actively talking to investors. The feedback has been very positive, and I guess it speaks to the general perception of what the opportunity in residential real estate is in a country such as ours, where 90% of urban dwellers are tenants and likely to be tenants for a long time. So I like saying what we sell, what majority of us sell, is an investment product. I'm selling a unit to Julian, who is looking for a yield.
Yes.
And therefore, if we can find a way of bridging on one side a developer with sort of very impatient capital, and the demand dynamic, which is more for rental, long-term rental, if you can find an in-between that kind of take from the developer and hold for that long-term rental, then that provides a very good way or dynamic or mechanism for developers then to platforms to scale.
Yeah.
Because the demand for what I would call affordable, lower middle to middle income residential rental is long-term, is very deep and very long-term. Despite what the government is doing and what all of us are bringing to the market, I don't think we are doing much to chip it out. We are urbanizing at a very fast rate. This city, for example, is adding upwards of 200,000 residents per year.
Yeah.
They need housing. Old stock housing needs to be replaced. So the demand is deep. It's what products, what financial products can we then originate and structure and create to speak to that character of the market. I think this product we are toying with in a way addresses that. It addresses on one side the demand character of the market, but also it addresses an investment need by the investing community, because the target IRR there is about 18%. So what we've done then is to say you create a rental platform. It buys products at a discount from our DevCo. It then holds them for a medium term, 3 to 5 years. Because you're buying at a discount, and based on the yields we are seeing now, 11 to 12%, it means you can get a rental yield of 12% as the investor, but the capital gain, instead of having it just as a book valuation, realize it within 5 years. So within a 5 to 7 years.
So that's how we get to the 18 IRR.
That's how we get to the 18.
I see.
So the yield plus a realization of the cap gain. And what we've done, I think what we did is to validate that. So far, we've now closed 3 transactions on bulk offtakes with one institutional fund or developer. And on the other side, we closed a smaller, if you recall, bulk deal with a local pension scheme. The whole idea was to validate that the model works and validate the kind of IRRs we think people can make or institutions can make, and that has been validated.
Okay.
So I think a promise of 18% odd is now validated, but also the way one can structure that kind of an investment and the platform is also something that then is based on a real business case.
Sam, it sounds to me like, one, you're already engaging in fairly aggressive book building here.
Yes.
For the fund, what sort of tickets would you be looking at as a fund size? And secondly, because we've seen a lot of, not really a lot of, we've seen players coming to the market with hard currency denominated REITs.
Yes.
Are you looking at CARES? Are you looking at USD? Because that is becoming quite a trend in the industry.
That's a great question. In fact, I may speak then to those 2 REITs. I found those 2 REITs very exciting. I suppose as an industry, we've really been supporting transitions into REITs and those kind of vehicles. So when the ALP REIT successfully closed, I think oversubscribed, we were really excited about that. And the recent one, the Terrific REIT, we've been really watching the Terrific REIT. Not necessarily just from you want REITs to be successful, but if you look at the design of the Terrific REIT, from what I've read in the public domain, they're not just looking at assets within the Terrific zone itself.
Yes.
It's any qualifying asset can be onboarded
correct.
onto that platform. That's really exciting. It's almost like it's an umbrella REIT. And if you ask me, that's really very transformative. Maybe in the future they may as well accommodate residential. and Triffic can as well take some of my residential products. So they are USD because the underlying assets, at least for now, both for the Triffic assets and the LP assets, are dollar rentals.
Yes.
They are dollar leases. In our case, because you're looking at a local affordable housing play, it's like it will be a case. The rent is case, and therefore the fund or the rental platform itself is going to be a case denominated play.
Okay.
Yes.
And question one on the ticket. Yeah. For the
So,
fund size, yes.
Maximum 10B. Our first close is targeting 45B. Just to give you then, if I translate that into scale, $1 billion should be able to do a project of about 150 to 200 units, depending on the sizes. So I guess the first lot is looking at the first 1,000 residential units across our existing sites already. Because these projects you're putting into that fund or into that platform are already shop already. Yes. They are within our existing sites. Yeah, so initial 45B, then close at 10B.
Okay.
Yeah.
Interesting. We shall keep an eye on that one,
Yes.
given the sort of interest I've seen
Yes.
on my mailbox from
Yes.
Kenyans.
Yes.
Sam, you seem to really have unlocked institutional offtake as your sweet spot. And for those of us who have always asked ourselves, why is it that institutional players don't see other asset classes as being viable? What exactly have you done to unlock this?
Yeah, I suppose you could argue it's been one of the bigger challenges of this market, right? And I don't know that it speaks to how unsophisticated or how we still are placed much lower in that development sort of continuum, because multifamily assets form part of the portfolios of global funds. If you look at Blackstone or BlackRock, multifamily holdings are a big chunk of their portfolio of assets. In this market, very few, if any, pension funds hold residential rentals at scale. Yeah. You can point to a few who have done their own development. And I think there are historical challenges to it. One being that pensions have historically held a lot of either illiquid land or commercial buildings whose performance have been somewhat mixed. So I think that to me has been an opportunity for this market that can then be developed. Even if you look at the kind of institutional deals we have closed, all of them other than one have been with an international fund, not local funds,
yes.
not a local fund. So that tells you a lot then about what I spoke earlier about just a local sort of perception. I don't know if it's a perception of risk or the dynamic that we are already overexposed. We are heavy in real estate, so we can't move into multifamily. So that could be that. You could also argue, to be fair also to the capital markets, we have not had institutional platform who bring investment quality assets that these funds could invest in.
Yeah.
That also, I suppose, on our side is the reality. And maybe it's a chicken egg situation. Do we first develop to bring them in, or do they move in so that we can then develop? There's always that. And I suppose these deals we've done with, say, International Housing Solutions or the local pension fund, I hope they become the sort of buds, sprouts that can then demonstrate actually this is an asset class that not only is it defensive, even in the downside part of the economic cycle, but actually the yields are better than what you'd get from a government treasury bond. If you look at the hybrid or the blended return from a rental yield itself, and also the capital gains being realized.
I see.
Yeah.
Sam, you spoke about the funding nature of the real estate space. You've got a bit of impatient capital. You've got long-term sort of projects. Two questions here. One is you are one of those who develop green buildings. I see a low-hanging fruit from the DFIs here. Is that an option on the table? Are you facing any challenges with that? Secondly, we have seen a mortgage refinance in this market go to the capital markets with a green note, massively oversubscribed. I mean, they're looking for 3 billion, they got 9 billion. It tells you there's liquidity. There's liquidity out there. Is that an option as well for you?
Okay. And I agree with you, there's liquidity. If you look at the recent bond raises, or even the recent transactions in the REITs, it does so there's liquidity and there's some appetite.
And the pricing is fair.
And pricing is, it's very fair. It's actually very fair. So to your first question about green, I think on paper it should be almost obvious, but if you now have local platforms who are at scale developing green buildings, EDGE certified buildings, ordinarily then there should be, you'd argue then you'd see a lot of capital that is focused on sustainability and green move more towards them. And I think we've seen a few.
Yeah.
I think I've seen IFC finance a few EDGE certified portfolios. Is it at a scale that potentially is a game changer in the industry? Maybe not. Is DFI a good play? I think DFIs will always be a target for platforms such as ours. They bring a little bit more other than the capital itself. In addition, obviously, crowding in other DFIs and local capital. The sort of strengthening they bring from a governance perspective, I think benefits a lot of local enterprises. My own reading has been in the last year or so, or maybe the last 2 years, there's a bit of a drought in DFI flows to the private sector or to our nature of. And I don't know, I can't explain why. And I'm hoping it's just more of a phase, just a mistiming between when they are deploying and when some of this capital is needed. But I think because of the DFI play and sort of global PE play that has been in this market for a while, we have matured to a level that we can prepare enterprises and platforms for either PE or DFI investments. I think we've gradually over time transitioned or transformed our mindsets, the way we run business and the way we prepare businesses for sort of investment, whether local or offshore, to be able now to attract. And I'm hoping then just a question of time, just a question of when we'll see more capital flowing from DFIs. Is a local green bond a potential play? I would say yes. I think if I look at where we are at the moment, we are at having acquired a portfolio from Actis. We are at a point now where we are scaling it up for the next sort of phase of growth. So acquire, originate schemes, de-risk them to some extent. Then you can say I have an investment grade asset of scale to a level that can sort of whet somebody's appetite because also they look for big ticket sizes. So would I see in the next 5 years or so potentially we go into the market with a green bond? Yes, I wouldn't put it far from, but it's not immediate.
Okay.
Yes.
Can't believe we've shut our time, Sam. Let's close this. Last year you consummated a management buyout, and you've already touched on it in your last response there. I know it might be early days. How is it shaping up? How is your strategic outlook different from what we knew in the past?
Okay. It's been a busy, very busy 6 months since you acquired it. I've grown some white hair, as you can see in the process. And I think the play there was always, in our view, transitional. Transitioning the element that on one side you had a great investor. Actis is a great investor in terms of strengthening institutions from a governance perspective, from developing values-driven institutions. So that heritage still lives with us. So the idea is acquire, then sort of build on those foundations to scale a bit more rapidly, and then bring on board another institutional investor, because the institutional character of Mevida must never change. Today Sam is here, 10 years Sam will retire, somebody else has to come. So it has to be a going concern that retains that institutional character. And as I like putting it, the way it's governed and the way it's run should always match, if not better, NSE listed or regulated entities. So it must always be at that level, which speaks to why we are not opposed to an idea of saying we should at some point, at a very minimum, issue a bond, because it keeps us within those sort of regulated and high levels of governance and running the business. So it's been great. Of course, it's great to own a business, I suppose. But I suppose the challenge to us has been building on those foundations now to rapidly scale, and now on board another institutional investor, which we are working on in the medium term.
Tell me more. Just give me a snippet of that.
No, it's exactly that. I mean, it's saying that you bought a portfolio of this quantum or this value. Now, obviously, when it transitions from one set of investors to another, the risk appetite somewhat changes.
Yes.
And the risk appetite has then changed to say we now need rapid scaling, but in a balanced way, in a way that another investor can then look at that platform, see the foundations that that sort of were inherited from the previous investor, what you've done to build on it, and then that investor can then invest. So we are open. We never intended to make this 100% management-owned business for it, for the long term.
Yeah.
No, the idea it's really a transitional sort of arrangement. So don't be surprised if, say, the next.
So I wouldn't be wrong to define, without giving away too much.
Yes, yes.
I know some of this might be subject to NDAs.
Yes.
You are looking at a more retail-focused, rental-focused, if I could put it that way in the real estate sense, institutional-leaning investor.
That's actually a very good distinction because the rental platform, which is going to be institutional investors, and the institutional investor into Mivida to own common shares in Mivida are two yet somehow related. So both are institutional plays. But the rental platform, initially when we discussed, we were thinking of a fund, but now it's a platform. It's like a company of its own. It's going to have institutional investor. Its only strategic import is that it takes from a DevCo. But the institutional play I'm now talking about is an investor coming to invest in the common stock of Mivida. So to your point then, yes, you do have potentially two separate fundraisers, which would be ongoing at any point of time.
All right.
Yes.
Anytime I sit down with Sam, we could go on and easily clock 2 hours. Unfortunately, we have to close this conversation at that point, focusing on the real estate, the macros and how they're impacting the space, the developments we have seen coming from Mivida, whether it's at Tatu City, whether it's at Keza and Ruta, and many others which are coming. The sort of horizon it takes before these numbers hit their P&L, I'm quite shocked by that, and the income statement. And finally closing in on the management buyout, which they consummated in late 2025, and how it's shaping up and impacting the strategy of the business. As always, you'll keep on getting the latest on Mivida and the real estate sector here on Business Redefined.